BTI looks to be undervalued and offers a yield of 9%. But in today's episode, we're going to take a look at, is British American Tobacco a buy now? We're going to run through the risks that we see with the company, with different essential countries looking to ban cigarettes for the next generation. We've got a lot to run through. We're also going to take a look at the portfolio of the company. We're going to jump into the income statement, look at the revenue growth year on year, as well as that bottom line net income. We're going to jump into the balance sheet, take a health check, total cash versus total debt of the company. And this will tie in nicely to that all important dividend safety and how secure that 9% dividend is, as well as some very important supporting financial metrics you need to understand before investing into BAT. And as always, we will run it through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given that margin of safety. Now, it is down 22% year to date, right there at that 52-week low with an incredible forward yield of 9%. So what we want to understand in today's episode is, are we looking at an incredibly cheap price which we expect to double or triple over the next 5 to 10 years? And can we expect to lock in this very high yield and see our yield on cost go into double digits over the next 3-4 years? Now, investors who have been holding the company over the last 10 years would have seen an incredible 349% total return on their investment. But bear in mind, this does not include those dividends reinvested. So what we want to understand is, can we expect to see similar growth, if not more, over the next 10 years? And in line with this, can that yield on cost go into some high, strong double digits? Now, in terms of the company itself, well, the top line revenue, how has that performed year on year? Typically what we like to see, 3 to 7% growth. So December 2018, around 31 billion on the top line. December 2022, their latest annual report, around 33.5 billion. So around a 10% increase, or just under a 10% over the last 5 years. Not exactly as high as we would like. But when we look on a more granular level, what we can see, 2018 top line to 2020, it has increased year on year. But from that period, from 2020, it has started to come down. And we'll touch upon some of the reasons why we are seeing this later on in the episode. Now, in terms of the net income, well, how has that performed, in line with the revenue or not? 2018, 7.7 billion on the bottom line net income. Latest annual report is showing around 8.1 billion. So the bottom line has increased over the last 5 years. But again, a fairly similar story with the top line revenue inconsistency. 2018, it has gone down to 2019, but then it does pick up all the way to 21 before dropping down to 22. So a slight inconsistent business in relation to the top line and bottom line movement. And now when we take a look at the balance sheet, a quick health check, I like to always look at the total cash versus total debt movement. 2018, around 3.5 billion in cash sitting in that balance sheet, including short-term investments. Latest quarterly report, they are holding a significant amount more cash, around 5.2 billion, than they did 5 years ago. Now, how does that compare numerically and directionally to essentially the total debt? Well, what we can see, 60.6 billion in 2018, so a lot of debt. However, on a much more positive side, they have reduced this to around 53.5 billion. So what's really positive to see is the reduction in that debt over the last 5 years, in conjunction when we take a look at that total cash, the increase in cash. So far, it's positive. And before we jump straight into looking at the dividend safety and supporting financial metrics, we're just going to touch upon some of essentially the issues that we can see in the foreseeable future. For those that don't know, well, New Zealand passed a law to essentially ban smoking for the next generation in tobacco. Again, this was something, it's not new. This was released at the end of December, but it's something to essentially bear in mind, with this being one of the main products that British American Tobacco have, and we will touch upon the products shortly. Now, something like that seems to be contagious. We see Rishi Sunak from the UK considering banning cigarettes for the next generation. So it's not something that's just related essentially to the British American Tobacco Company, but also the other companies, Altria Group, as well as Philip Morris and Universal. So again, there are some risks around this industry as it's dying out, But one thing to note as well, not only where we could be seeing legislation coming into play, banning cigarettes, but again, another thing to bear in mind, as we touched upon, and we can touch upon again with the revenues, the trend that we are essentially seeing in the tobacco industry is that volume is decreasing. People are buying less cigarettes, and what this essentially means, a way for companies like BAT to combat this, is they are increasing their prices. So whilst we may see top line growth, it's not necessarily an indicator that more people are smoking, but it's quite common in this industry for the prices to continually be raised, as essentially people who do buy cigarettes are more likely to continue buying even if the price goes up by 10, 15, 20%. Now, in terms of how a company like British American Tobacco are combating this, well, they are investing heavily into other essential areas, not just the combustible section that we can see here. A lot of companies that you may or may not know, depending on whether you're a smoker or use these products, but these are some quite famous ones. They are also investing heavily into other areas, diversifying. You also have vapes, again, oral vapes as well, or oral tobacco products. Given that it's not something that I use, it's difficult for me to explain these brands, but some of you may understand these brands and what they come from. Now, in terms of how that affects the essential dividend safety, which is very important with this very high yield, 45 score making it borderline safe, market cap of 70 billion making it a large cap company. And let's run through and see whether or not we agree based on these metrics. First of all, those that believe we're heading into a recession, here are some metrics for you. During the 07-09 recession, they did in fact increase the dividend. Surprisingly, their recession sales was plus 5%, which was above the average growth rate of companies in the S&P 500, because companies in the S&P 500 during this period, in fact, had negative growth. And again, we can see here, negative 31% recession return. This did beat the S&P 500's negative 55% return from the same period. So something just to digest for investors, especially those that believe a recession is looming. Now, they have been increasing their dividends over the last 23 years. Well, why is this important? Well, companies do gain a status called dividend aristocrat status if they have consecutively increased those dividends 25 years in a row. So BAT are not far off. Now, in terms of the dividend increases, what we like to see, personally, before we look at this data, 4% is what I typically say. US inflation rate over the last 40 years was 4%. Anything less in your dividends, salary, or other income producing assets, you are in fact taking a pay cut and losing your purchasing power. So 1% over the last full year, 21 to 22. So we are waiting for the increase for this year. 4% over the last 5 years. 20% or 10% in fact over the last 10 years. Now, why I don't mind something like 4% as we can see here over the last 5 years, if you want to look at more recent data, well, you're essentially getting an increase every single year in line with inflation. But on top of that, you are getting a 9% yield. So in my personal opinion, so far, so good. Now, in terms of dividend yield theory, well, it states that a company is undervalued when the current yield sits above the 5-year average, 8.91 versus 7.38. So we have our first sign of undervaluation. However, as always, we never look at any model in isolation, and we'll draw our conclusions towards the end of the episode. Next model that we're looking at, well, forward PE ratio, 7 versus the 5-year average of 8.7, another sign of undervaluation. And we can see here the sector PE coming significantly higher than that of BAT currently. So 52-week price range, I did mention at the beginning of the episode, right there at the 52-week low. But again, do bear in mind, it's quite important to understand 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Earnings versus free cash flow. Now, there are new viewers who are watching this. Well, earnings metrics data is something we tend to ignore. It is susceptible to manipulation by management through accounting. So free cash flow is the more accurate and appropriate metric, but I'll keep this up there for investors that like to look at that. So for tobacco companies, we like to look at around 85% or lower. And from 2018 onwards, so roughly the last 5 years, it has in fact been well below 85%, 50% in 2022, with 2023 expected to be 59%. So very strong to see. So far, it gives me faith in that all-important dividend safety and alongside that yield. And one thing just to bear in mind for those that like to compare, this data is much lower, so the free cash flow is much lower in BTI than it is in Ultra, which we reviewed yesterday. Now, earnings per share data, again here for investors that do like to look at this data. Free cash flow per share is what we will focus our attention on. 195 in 2013, 432 in 2022, so more than double growth over the last 10 years. Always positive if you can to look at least 10 years worth of data to gauge a good idea of a business and how it's run and its operations and efficiencies. $4.07 though, it is expected to drop slightly in 2023. Now in terms of sales growth, this is what I mentioned earlier. We do look for 3 to 7% year on year. Again, do bear in mind, given the US inflation rate being 4% on average, if companies are unable to hit that at least year on year, then it could signal in real terms that their revenue is dropping. So overall, we can see it's very inconsistent. We have 2013 to 2015, a period of negative growth. Then we have some nice double-digit growth and then relatively flat over 2020 and 21 before increasing in 2022. So it is fairly inconsistent. And what we can see numerically, around 15 billion on the top line in 2013, just under double at 28 billion in 2022. But between that period, we can see where it was going in a downward trend before picking up and then staying flat. So bear in mind, it is an inconsistent company. Now, shares outstanding, regular viewers, you know we love it when companies do share buybacks, returning excess cash into our pockets. But what we can see here for BTI, they've done the opposite over the long term. 1.91 billion shares in 2013, 2.27 in 2022. So what this is signaling is they are issuing shares, which means they are diluting your position as a shareholder. Not really great when you do factor that into the equation so far. But again, another thing I do always say is if they've done it once before, they are likely to increase their shares again. ROIC, one of my 7 golden dividend metrics. What do I love to see? Personally, 10% plus, as it means management are able to effectively allocate that capital. Anything less, in my opinion, it's not really positive. But again, it does depend on the business. What we can see here for the large part has been below 10% from 2017 onwards, but it has straddled around that 10% between 8 to 9. So it's not bad, but I would like to see 23 and onwards hit that 10% as a minimum. And if you want to see my 6 other golden dividend metrics, do check the pinned YouTube video. Operating margin, free cash flow margin, not much to say other than significantly very, very strong. Over 25%, which is what we look for on the operating margin, very consistent at that. Likewise with the free cash flow margin, over 20%. Net debt to earnings before interest, tax, depreciation, amortization wasn't something I really flagged when we looked at the balance sheet, just given the fact that directionally they were increasing their cash significantly whilst reducing that total debt. But what we do look for tobacco companies is a maximum of 3 signaling the number of years it would take the company to pay off their debt net of cash on hand. What we can see from 2017, where it was extremely high at 5.28, it has started to come down with 2022 at 2.96, and positively 2023 expected to be slightly lower at 2.89. Gives me faith in that dividend safety that we could see at 45. So far, I do have faith that dividend will continue to be paid. And on the right, we see the net debt to capital, essentially showing us the percentage of a company's financing from debt as opposed to equity. As always, if you are enjoying the video, value is being provided, smash that like button and do subscribe and hit the bell if you haven't already to join this lovely community and have these videos delivered to your doorstep every day. As always, if you do want to grab a copy of the valuation model to run your own companies through to get your own intrinsic value for companies in your portfolio, do grab a copy in the pinned description below. Now, Graham's valuation, essentially what we have here is the stock ticker, BTI. We have the earnings per share. We have the growth rate per analyst estimates at 12, with that current yield on AAA corporate bond at 5.32. This gives a valuation based on Graham's model at $74. Now, we can see this is significantly higher than the current trading price and more than double the current trading price, which means another thing to bear in mind is that not only are you getting a very strong yield, but there is severe undervaluation based on this model, and you would expect your yield on cost to grow to double digits very, very soon. Then moving on to the second model, and as always, do remember we never look at any model in isolation, and we'll conclude at the end of the episode. We have essentially 3 companies in a similar sector and size. We have Altria, which we reviewed on the channel yesterday, so do go check that out. Philip Morris and Universal, and we essentially have their earnings per share. We get their PE multiples, of which we get the average multiplied by that of BTI to get a stock price based on the multiples valuation of $61. Again, significant undervaluation, almost double the current trading price upside, showing that it looks to be undervalued in the current market. We then essentially move on to the third model, the dividend discount model. Now, one thing to note with this, while you can see some negative here, do bear in mind this is a UK company and dividends are paid out in sterling, so FX rate will slightly differ in terms of their growth rate. So forward looking, what I've estimated is around 3%, slightly lower than inflation at 4%, which was the average over the last 5 years. So you could argue it's a more conservative level. But as always, if you do want to justify a higher or lower percentage, grab a copy of the model in the pinned description and run your own figures through. So this gives a DDM price of $55. Again, upside to the current trading price, above the 52-week high. And again, remember, you are locking in a very high yield. So as that price does go up, your yield on cost will go higher and higher. We then have the DCF model, the discounted cash flow model, with the free cash flows year on year. Average growth rate around 12%, with that analysts estimating 1. So very, very conservative in comparison to the last 10 years. But you could argue it is justified. With that discount rate, we get the present value of future free cash flows and terminal value. Add that together with the cash, subtract total debt, and arrive at the equity value. Divide that by the shares outstanding to give a DCF price of $75. Again, significant upside to the current trading price, more than double and well above that 52-week high seen not too long ago. As always, if you do enjoy the content, value is being provided, hit that like button. It really helps the channel out incredibly, and drop a comment as you go along this video. And as always, if you do want to grab a copy of the model, check the pinned comment. So intrinsic value is essentially the average of the 4 models that we have just run through. And with the current trading price at $31.41, you could argue a 10% margin of safety. Like I say, if it has a wide moat, strong financial metrics, good forward-looking data. Again, there are risks to consider with this company. So if you are looking for a 20% margin of safety, it'd be a buy up to 53, 30% up to 46. If you wanted a 40% margin of safety, up to $39, a 50% margin. So what we're theoretically saying is, based on the current trading price and the estimates and judgments in today's episode, if you were to lock in a price up to $33, you would be getting a margin of safety of 50%. Now, if you wanted 60%, you'd be looking around $26. As we can see, that's well below the 52-week low. So roughly around 50% margin of safety based on current prices, 55% for those that are interested, around $30. Wall Street are forecasting, though, over the next 12 months for the price to hit around $50. So they also see some significant upside to the current trading price. And as always, do let me know your thoughts in the comments below. Are you looking to add BTI, looking to sell, or purely on the sidelines speculating? As always, hit the like button if you have enjoyed today's episode. Do subscribe and hit the bell button if you want to join this lovely community. And catch you on the next episode, and have a lovely day.